It is getting more and more expensive to borrow money. Mortgage rates are now over 7% for a 30-year fix. And so the big question is, what will happen to mortgage rates in 2023? And what loan options are out there to help you purchase today if that's what you want to do? And in some cases, it may still make sense for you to purchase, especially when the other option is high rent prices. We're going to talk about a few options that you may have coming up.
I expect the interest rates to go up, which is going to have an indirect effect on the mortgage rates. What is your take on this?
I'm in an agreement. I mean, we can already see the impact that the increase in the rates have already had. And honestly, I think the next few months to the end of the year, it's going to be a rough patch, meaning it's going to be higher rates. I don't know how high. I don't even know if we'll see them actually get to 8%. I do think that once we get inflation under control, because the mortgage rates they're directly correlated with inflation. So as soon as we can figure out a way to get inflation under control, which by all means should start to happen the beginning part of next year, then we should see the mortgage rates follow, so that by late spring, we should have some more favorable interest rates. Now, how low will they go? I don't know. Could they get down to 5? That's what some forecasters think by the end of next year. So this time next year, we could see rates drop down quite a bit. But for now, until we get a handle on inflation, we're just going to continually see them go up a little bit more. One of the things that has come out, guaranteed rate, Affinity offers it and some other lenders are doing it, is called a temporary 2-1 buydown. And what it is when you have a motivated seller and they're willing to pay concessions towards a buyer's closing costs, we can use those allowable closing costs specifically to fund a 2-1 buydown. So if today's interest rate is 7%, and that's what they qualify for, they are getting a 7% 30-year fixed rate, but we take some of the money that the seller has provided towards closing costs and we put it in an escrow account. So then for the first 12 months, the buyers get a little bit of payment relief, and their payments are based on 5%, 2% lower than their actual mortgage rate. And then the second year, it's based on 6%, 1% lower. So depending on the size of the loan, it can save them hundreds of dollars on that monthly payment, with the opportunity, if the interest rates come back down next year, as they're anticipating towards the end of the year, refinance completely, if it makes sense, into a permanently lower fixed rate mortgage. So that's one way to offset that. It's not an adjustable rate mortgage by any means. It's a true 30-year fixed rate. What we're doing is we're just using some of the seller concessions essentially to subsidize your mortgage payment for the first 2 years.
Let's walk through an example. Maybe use a home price of $500,000 or $550,000. What would this look like at 20% down?
If it's a $550,000 house, you put 20% down. The loan amount that you would be looking to finance, $440,000. So in today's market at 7%, the principal and interest would be just over $2,900 a month. Now, if you were working with the seller and we took advantage of the 2-1 temporary buydown, the first year your payments would be based on 5%, which would lower that $2,900 to about $2,360. So about $565 less per month essentially would be paid by the seller for the first year. And then the second year at 6%, it would go a little higher to over $2,600. So saving about $360 a month, again, subsidized by that seller credit that we've collected at closing before it kicks into the first, the full 7%.
Okay, let's change gears a little bit and talk about the effects of Hurricane Ian. I've actually gotten quite a few calls already from potential buyers who've been displaced because of Hurricane Ian. Some of them have had insurance, and so they're waiting to get that payout. Some of them, unfortunately, have not had flood insurance, but they're wanting to stay in the area in Southwest Florida, but many do want to leave Fort Myers and the Naples area, and so they're actually looking to the Sarasota, Bradenton, Lakewood Ranch area. Do you have any opportunities for them to ease, the transition into purchasing a new home again?
Absolutely. FHA, which has been around for years, they have a program specifically for disaster relief. It's their 203H program. It's not new. It's specifically for disasters. And we've not had to really look into it in a number of years, but it essentially allows a borrower to qualify under, for the most part, normal FHA guidelines. But if they have lost their home in a federally declared disaster area, they have up to 1 full year from the date that it was declared a disaster to find a new primary home. And then there's steps when we go through the qualifying to exclude their current home that may have been completely destroyed that did have a mortgage on it to enable them to qualify for a new FHA loan with no money down, except for closing costs, unless the seller is willing to help and contribute with something like that. So it's a powerful loan. It does help for people to get back on their feet. They need a place to stay. They need safe shelter. So it's definitely worth looking into. We certainly offer that, but anybody that has any questions about purchasing a home when they're still in limbo, not knowing what's going to happen with their current home, with insurance, but they need a place to live, it's definitely worth looking at.